So welcome everyone to our Emergence online preview session. This is part 2. So today they're basically broken up into 2 components. So the first part is you'll get to see some of the companies that we're going to be featuring during the main conference at Emergence. What we've decided to do is, because of the incredible amount of healthcare and life science opportunities and medical device opportunities that we've got the great opportunity to work with, we've also extended that component into also the main conference as well. So in this session, you're going to be hearing from a range of different opportunity types, whether it be, as I mentioned, life sciences, medical devices, deep tech. We've got an incredible space opportunity for investors, as well as private equity, and also a range of different funds in the private credit space, access to property opportunities, and even sort of listed company related opportunities. So we've got an incredible session for you coming up where you get a bit of a preview to some of the companies. We're going to be doing sort of 1 to 2 minute insights about what they're doing. And then after that, I'm going to be doing my keynote presentation for the session. And this is basically the keynote I've been doing as part of my investor meetup series. I'm in an incredibly fortunate position where I get to see a lot of the trends that are taking place sort of in the market, both from the companies that I speak to, the fund managers that I have access to and speak with, but also I spend 2 to 3 hours a day understanding where everything is going, because I want a sort of full market sort of perspective, but also because we are working right across, the whole entire private market space, and also some listed as well. I also want to provide that perspective for investors. So I'll be covering a lot in that session. So make sure you stay tuned for that. It'll be my keynote at the end, following the featured companies. Enjoy the Emergence Online Preview Session, Part 2.
CEO at WaveWise Analytics. We're building a non-invasive continuous ultrasound Doppler monitoring device to support critically ill unconscious patients during surgery and ICU stays, solving a costly problem that existing solutions don't adequately address today. Our advantage is that we offer a non-invasive and easy-to-use solution that is cost-effective, and we're looking forward to starting our first in-human study later in the next couple of months. We'll be initiating a new capital raise later this year, and we'll be presenting at Sydney Emergence 2026. I look forward to connecting with you.
Hi, I'm Evan Thornley, CEO at Longview. Looking forward to seeing you at the Wholesale Investor Conference. Longview is solving the strangest problem. Why is there no investment grade fund in the single biggest asset class in the country, residential property? So we launched our first fund 2 years ago. It's now just been closed. Very successful fund, $50 million in it. Our most recent year's performance was 16% unlevered, net of fees. And we're launching our second fund shortly. The capital growth on Australian homes is the single biggest wealth creator in Australia. It's more money every year than the entire federal government budget. And yet there is not a sensible way to invest in the capital growth in Australian homes, except obviously buying your own and being one of Australia's 2.5 million landlords and the $2.2 trillion which is invested in rental properties. A fund grade structure, diversified across hundreds of homes, diversified across price points, markets, and professionally selected by the best data science and buying advisory team in the country, from a company with 120 residential property professionals and data scientists. That's the way this asset class should be done. Come along to Wholesale Investor Conference and you'll hear about what we've done, how well it's performed, and what you can do to get on the waiting list for the second fund.
Hi, I'm April Walker, the founder and CEO of Western Australia Spaceport. We're building the proving ground infrastructure for the space industry, the SA Lab or pilot plant equivalent, where in-space technologies are validated and de-risked before they scale into commercial operations. This is not a commercial launch site. It is a fit-for-purpose validation facility, the missing infrastructure layer between lab-ready technology and commercial flight. Incumbent infrastructure globally, namely in the US, is not fit for purpose or is at capacity. We have been executing continuously since 2019, Completing feasibility, engineering and cost planning, we obtained security of tenure from the WA State Government last year, and we're now in the development approval phase. We started on-site activities in September last year. The project is listed in the United States Space Force Capabilities Database, is the first space project and first Western Australian company accepted into the UNSW Defence 10X program, and has received seed funding from Banksia. We have $69 million in early commercial interest from US and Japanese customers across defence, enterprise and in-space technology. We're now raising $4 million to complete our regulatory approvals and be operational by 2027. I'll be presenting at Sydney Emergence 2026, and I look forward to connecting with you there.
Hi guys, it's Stephen Kroll here from Rhodes Asset Management. We operate a private credit fund, which is a pooled mortgage fund. We pay our wholesale investors 8.85% per annum for a minimum term of 12 months, with interest paid monthly. Private credit funds are surging in popularity at the moment due to the relative low risk of this asset class. Combine that with the stability and regular monthly income. What we found is many of our wholesale investors and family offices are holding this asset class as a defensive investment to protect against volatility. If you're in this position and looking to put some of your portfolio into a more defensive investment, I'll be at the Emergence Sydney conference on the 18th to the 20th of February and presenting on the Thursday. So feel free to seek me out. I'm happy to have a confidential chat to you at the conference, and I look forward to seeing you there in February.
Hi everyone, and greetings from Flanders, the northern region of Belgium, and your launchpad into Europe's most connected and innovative ecosystem. My name is Bart Boschmans from Flanders Investment and Trade. We are the government agency of the region of Flanders, helping our companies to go international and attracting foreign companies to invest in Flanders. Flanders places your business at the heart of Europe, with 60% of the continent's purchasing power just a few hours away. Our ports, airports and digital infrastructure make scaling fast, seamless and global. But what truly sets Flanders apart is our R&D and innovation power. And despite our relatively small size, we're leaders in life science areas as biotech, medtech and digital health, as well as advanced manufacturing, clean tech and smart logistics, powered by world-class universities and a unique collaboration model that accelerates research into real-world solutions. Our multilingual talent pool is internationally oriented and future-driven, making Flanders a preferred location for companies building next-generation technologies. And when you have plans for Flanders to invest in Flanders, you're supported from day one by our office in Melbourne and by my team in Brussels. We offer strong incentives, tailored innovation support, and hands-on guidance to help your project land and grow smoothly. At a time of global transformation, Flanders invites you to partner with a region built on ambition, creativity and innovation. Welcome to Flanders. We look forward to meeting you at Emergence.
Hi, I'm Tim Hyde, the CEO and co-founder of Swan Systems based in Australia. Swan works where climate change, water and food production meet. Climate change shows up first through water, more droughts, more volatility, tighter regulation and more competition for the same limited supply. Agriculture still uses 70% of the world's fresh water, yet a lot of the water never reaches the crop. The issue isn't a lack of knowledge. The science exists. The hard part is applying it consistently across the system, providing an outcome. At the same time, new pressure is coming from outside of agriculture. In places like Sydney, current planning suggests data centres could use up to 25% of Sydney's water in the future. That creates a real need to offset
with practical use for sustainability projects. And that's where Swan comes in. Swan's a precision water and nutrient management platform. We combine on-the-ground data like satellite imagery, weather forecasts, crop science to generate clear, site-specific irrigation plans for the next 7 days. We generally save around 500,000 litres per hectare, up to 20 to 30% of the water. We're hardware agnostic, so we work with what's already installed, no lock-ins, no replacements. What makes Swan different is it's measurable. We don't just help people use less water, we can show it, verify it, and report it. And that's why large technology companies are engaging with us. We're delivering water stewardship projects and replenishment projects with groups like Microsoft and Google, and we're in active discussions with Amazon and a few other technology companies. These projects fund real water efficiency improvements across farms and municipalities to help offset growing corporate water demand. Today, Swan operates in 11 countries across agriculture, municipalities and institutions. Our model is a simple subscription model, price per hectare with strong retention and long-term customers. We're now focused on scaling, careful and responsible. If you're interested in partnering with us or joining us as an investor, we'd welcome the conversation. This is a long-term journey, but we're in the process of building something practical, proven and needed. Swan makes water sustainable, measurable and investable. I look forward to hearing from you. Thanks a lot.
Hi, I'm Ben, Managing Director of One Key Group. We're building a scaled workforce solutions platform focused on Australia's most constrained labour markets, particularly across regional, infrastructure and energy-driven growth areas. Australia's skill shortage is structural, not cyclical. Demand across civil, renewables, resources and essential services is outpacing supply, especially outside the capital cities, and traditional recruitment and labour hire models are struggling to keep up. Our solution integrates labour hire, permanent recruitment, training, skilled migration pathways and managed workforce delivery into a single, regionally focused platform. It's designed to solve workforce problems end-to-end, not role by role. This isn't a concept stage business. We're scaling a proven operating platform with established clients, real revenue and a track record in complex operating environments. We're now expanding deliberately into adjacent sectors where the same constraints exist, but competition is fragmented. We're raising growth capital to accelerate this next phase, including regional expansion, skilled migration capability, and the leadership and systems required to support that scale. I look forward to connecting with investors who see the opportunity in essential workforce infrastructure and scalable cash generative businesses.
Hi, I'm Ray Treverson, Fund Manager and Director of OTG Capital. We're pleased to let you know that OTG Capital will be presenting at Emergence 2026, Convergence and Abundance in Sydney, the Global Investment Conference. I'll be on stage Thursday, February 19 at the main conference of the Four Seasons Hotel, Sydney. We're told there'll be over 1,500 active investors. So come along and discover how OTG Capital's Keep It Simple approach to investing in private credit has been benefiting our clients for over 7 years now. I invite investors and family offices who are seeking solid investment returns, backed by secured real estate assets, to join me during the presentation and connect with us directly at our booth for the duration of the show. See you at Emergence 2026, and thanks for watching.
Hi, I'm Marion Gartinger, Chief Operations Officer at Wholesale Energy. We are developing next-generation photovoltaics that achieve higher performance at significant lower cost across a much wider spectrum of lighting conditions, including superior performance on cloudy days. Low orbit satellites and high-altitude unmanned drones are in ever-increasing demand. However, the problem is they need power. Current solar technologies are cost-prohibitive for many companies. In the case of gallium arsenide, prices are above 85,000 Australian dollars per square meter, with over 2-year lead times. At Wholesale, we are developing lightweight, flexible, and affordable perovskite solar cells to address this issue. Currently, we are raising 3.2 million Australian dollar, which allows us to prove our solar cells on test flights. Paul Mooney, our CEO, will be presenting at Sydney Emergence 2026, and we will love to connect.
Hello, and my name is Mark Pitt, and I'm the founder and the CEO of DIT AgTech. We build and develop precision water supplement technology, from the hardware to the software and the telemetry, and also a whole suite of animal supplements to help our farmers increase production and sustainability. We've currently got nearly 500 doses deployed across Australia, and on any given day we're supplementing over 370,000 head of cattle, with a lot more animals coming onto our platform every day. We're currently raising capital at the moment at DIT because we've got a very unique opportunity, and that is with the advent of the approval of our carbon project with Vera, a global standard. We can now incorporate methane reducing additives into the water and not just reduce methane, but enhance productivity for our farmers, but more importantly, produce carbon credits fully approved, ready for sale. Therefore, we're raising capital now to allow all of our current investors or future investors to participate with us in this exciting opportunity as DIT moves from an ag tech company more into the climate tech opportunity. I really look forward to seeing you all at Emergence 26 in Sydney. Thanks.
Hello, my name is Jared Stewart from Sharpbridge Funds Management Limited. We manage the Sharpbridge Equities Fund, which returned 61.49% in its foundation year. Our Sharpbridge team, with a combined over 100 years experience, has curated this fund to deliver investor first-class performance whilst maintaining strong risk management. The key benefits of our fund are diversification across approximately 20 global stocks, professional management by the Sharpbridge team with 2 portfolio managers, potential for high returns given our track record of 61.49%, a long-term investment horizon, no hedging or leverage, regular monthly reporting and liquidity is also provided. Our investment strategy is to filter through over 10,000 listed global companies and select only the very best from the market to generate the outstanding performance of 61.49% as at December 2025. Importantly, we've delivered this with less risk than the market and protected our investors from volatility. If you are seeking a strong risk-adjusted return from a global equities fund, we highly recommend starting a conversation with us.
I'm Peter Cook from AUDD. We are scaling Australia's leading stablecoin business, driving productivity and innovation in all industry sectors where money moves or transacts. Our advantage is our massive global ecosystem across many blockchains, many partners, well trusted, as we've done over $1 billion of transactions in the last year alone. We are now raising $17.5 million in a Series A to drive balance sheet strength and really scale the business. And I look forward to seeing you at Emergence 2026. Thank you.
I'm Mayor Khalid, CEO of Luminoma Diagnostics. Skin cancer is diagnosed by evaluating the appearance of a mole, so experts are inundated with referrals. Patients can wait months for an appointment, allowing time for the cancer to spread. To avoid this, less experienced clinicians will follow the mantra of if in doubt, cut it out. When I explained this to an investor, he replied, I know. My wife's had 24 biopsies, none of which were cancer. Health systems can't afford these inefficient practices, and patients are left bearing the cost, time and scarring from these unnecessary procedures. So Luminoma is developing a point-and-click device that will provide a biopsy recommendation in seconds. We're going to transform the skin cancer pathway from relying on the dermatoscope, a custom magnifying glass that leaves the diagnosis to the clinician's subjective opinion. You can see the challenge with this when you compare the image on the left which is a benign mole with a malignant melanoma. So it's not surprising to learn that the most experienced clinicians will still miss 1 in 8 cancers and will perform 3 to 30 biopsies to find a single cancer. Instead, we're developing an objective test that's going to reduce the number of missed cancers to less than 1 in 100 and reduce unnecessary procedures by 3/4. It's because of these efficiencies that the Mayo Clinic and UC San Francisco, as well as the largest dermatology chain in the US, all want to work with us to develop the device. So we're raising a $10 million round later this year to complete our product development and include US patients in our training set. So we're ready for the US market, where we've identified a $2 billion annual recurring revenue opportunity. I look forward to discussing our strategy with you at Convergence 2026 in Sydney. Thank you.
Well, I hope you enjoyed those featured companies that we've previewed as part of Emergence. As I said, this is literally lining up to be one of the best Emergence we've ever hosted. We've got some incredible companies and some incredible funds that we're presenting at this event. And like what you hear in my presentation, our focus in doing this is we want to provide you with insights from leading investment minds. We also want to help you discover curated opportunities in sectors that you're interested in, and you're the ones that told us what sectors you're most interested in. And the last one is high value networking. So that's the sort of experience we're going for, the Emergence experience. Now I'm going to get into my keynote, and I'll just sort of go through, just a high level agenda for everyone. So the first part, I'm going to be going through a 2025 summary. I'm also going to be sort of discussing some of the macro trends, and we're talking about technology and sort of market trends. I'll be going through venture capital and crypto, what's happening there, private credit and also private equity, and some of the expectations for 2026. I'll be talking about everyone's sort of favorite topic, which is the US, because it just seems to dominate the conversation in so many different ways. And at the end, I'll be sort of giving a bit of a high level on some of the wholesale investor opportunities as well. So to get started with, this is obviously not financial advice. All that sort of fun stuff, I'll leave that up there for everyone. It's meant to be just for informational purposes. Okay, so the outcomes for the session is that, one, as I mentioned, in the introduction, I want to provide some insights into what I'm observing, what I'm reading, and what I'm experiencing, as someone that's deep into this space and, speaking to anywhere between sort of 10 to 15 people a day. And effectively, whether you're an advisor, investor, or founder, we've got a sort of range of relevant opportunities sort of in 2026 that you can sort of take advantage of, and then likewise, the collaboration opportunities with WI. But to focus for me, this whole presentation will be focused on the insights as far as what I'm observing. So to start with, from a 2025 summary. So first part is I'll kick off with Australia. Right now, there's an incredible range of state and federal government initiatives that are very helpful for the technical related businesses. And whether a company's looking to get some early funding, or whether in the expansion phase, or whatever it may be, or they're looking to sort of test their potential overseas, there is a great amount of initiatives that companies can tap into as part of that governments have set up. So I think that's a real positive for the space, that those opportunities are available. There's obviously a great range of collaboration opportunities with universities and research institutes for the technical businesses. And one of those will be actually sort of featuring at Emergence as well, which you can stay tuned to hear about. And there's also a significant number of sort of former executives or current executives or former entrepreneurs that are looking to add value to the ecosystem. And to me, if you think about the amount of young companies that are coming up, this experience that people can tap into is something that you just cannot take for granted. And there's also a lot of people that have made their money overseas, now come back to live in Australia. And so there's just this depth of insight. And sometimes they represent themselves as advisors, as consultants, or even sometimes just investors sort of in the space. And from our recent survey, we noted that it was over 60% open to 60% of investors are open to ad hoc strategic calls, and they have strong backgrounds in banking and finance and go-to-market strategies, etc. So there's an absolute wealth of talent to be tapped into, at this point in time. On the downside, there's three structural forces which are driving a higher for longer interest rate environment. And, you're seeing that play out. And obviously, everyone's waiting for the sort of February rates decision. But the reality is these three forces are things which are going to make it very difficult to reduce interest rates over this next period. So the first one is immigration and temporary visas. And there's some stats that have come out, really strong that sort of talking about sort of how much that is contributing, to the economy at the moment. NDIS spending, it's been obviously a political topic, but for me, this is, just really where I'm looking at things and what people are saying to me or things that I'm observing that mean that the private credit opportunity is going to continue to expand sort of in Australia. And then the last one is the government spending expansion. And we've all seen that sort of continue, over the last few years, especially when you note that 80% of new jobs, recently have come from non-market related jobs. So those three factors alone are going to continue this higher for longer interest rate environment. Now, on the employment side, and I sort of speak about this because it's one of those things where very few are sort of willing to talk about it, but it's the common thing that founders talk to me and executives talk to me about all the time. And that is Australian employment laws are really becoming quite difficult to manage, to the point that for many, there's just no incentive, to actually hire in Australia at the moment. And one of the key stats I outlined is that, with workers' compensation as an example, 38% of money that went to workers' compensation claims was related to mental health related issues when it was really designed for physical problems that people experience in the workplace. The right to disconnect laws make it very difficult for companies in our space where they've got international ambitions and obviously they've got local teams. So it makes it difficult for them to actually operate. The firing and redundancy laws, if you've ever been through that process over the last few years, it is just ridiculous now. The process you have to go through, even for a redundancy, just makes it almost impossible. And then often what companies have, and this has also been publicly documented in news as well, is just how much the legal system's been choked up, or the workers' place legal system's been choked up because of all the various claims. And so fundamentally, the no-win, no-fee lawyer sort of situation where effectively, or employees can just simply have a go at getting some additional money makes it also quite difficult, because effectively it's designed in such a way where someone makes a claim, then the company obviously doesn't want to go to court. They go back and forth with the lawyer, and then they figure out a settlement, at some stage, and then basically, there's additional money, for the employee, so it just makes it really it makes it difficult to navigate as an employer. So, there's some of the key things that people are talking to me about, at the moment. So 2025 summary. So biggest thing I'd highlight straight off the bat is the Magnificent Seven. It's incredible. They created $4.18 trillion worth of value last year. Google led the way, by going up nearly 66%. Nvidia was up 20%, and Tesla was up 20%. 4.18 trillion is an astonishing amount of value created just from within those companies. Digital assets are institutionalizing, whilst crypto itself actually had a flat/down year last year, in comparison for where it hit its all-time highs and then sort of where it ended. But the reality is the institutionalization is coming, and that's because of the Genius Act as one part, and now they're waiting for the Clarity Act to come through. But effectively, you're seeing that across, the purchasing of Bitcoin, and obviously the ETF products, and likewise the rollout of different stablecoin opportunities, and even the listing of stablecoin related companies. And then also RWA, so real world assets. That institutionalization is really coming down the pipeline. Gold has obviously been the standout story, hit 53 records in 52 weeks, increased 66% in 2025. And then silver has had an astonishing year. It's obviously been going up since, of 144%. It actually outperformed every other sector except AI. So from a capital raising and innovation space, it's definitely bifurcated in that investment into AI and renewables has continued to gain strength and really soaked up the majority of funding. And then all other sectors have really struggled to get the market attention from a capital raising perspective. And then I suppose the glimmer of hope for everyone is that the IPO market is technically open. There were 67 companies listed on the ASX last year. There was $4 billion raised in primary raising, so through the IPO process. And there was a record $72 billion via secondary transactions. So companies that were listed and then decided to do secondary capital raises whilst as a listed company raised a record $72 billion. So that's very healthy to see from a market's perspective. And I'll just say that all of us as investors would love to see a bullish sort of IPO year for 2026, because that solves one of the biggest frustrations that you highlighted in our investor survey, which was the liquidity frustration. And then obviously geopolitics is capturing the market attention, in so many different ways, and really sort of taking over the investment narrative. And then this one I found super interesting was that the AI-related capital expenditure, which is obviously focused on sort of AI infrastructure, data centers, etc., accounted for approximately 92% of overall GDP growth. So that is astonishing to see in such a short period of time. Founder sentiment, this has definitely been a big switch this year compared to previous years. 2026 is the greatest time to build a startup. The build now mindset has really captured founders, where everyone is just aggressively focusing on how much they can achieve over the next 12 months, given the new leverage given the leverage and the tools that everyone has exposure to. It does really create an unprecedented opportunity. And then likewise, we all realize that this is a very rare window, for us to build in. As I said, as the tools keep getting better, and AI tools that is, keep getting better and keep coming online, it really creates a significant opportunity for all of us. So trends. So first one is, I've been saying this now for the last 2 years, that this is the best time that I have seen for investors to access growth, high growth, and also high yield opportunities. And you can really see that playing out. And I still believe that is the case. And I'll go through in my presentation, I'll sort of put in the fundamentals and I suppose the macro aspects and all the different reasons as to why I feel that way. So from a business trend perspective, the private markets opportunity, it's interesting. When I did a full analysis of all the different sort of family office and sort of high net worth investor reports at the end of last year. And it's interesting to see that 42% of portfolios have now shifted into alternatives. So alternatives have become the main event, and they've become the primary sort of engine for that sort of capital appreciation. The democratization of private assets. It was interesting to see Larry Fink's chairman's letter that he put out, where they really put actually these two aspects front and center in the focus on private markets opportunity and the democratization of private assets. So effectively now markets are moving towards mechanisms that can allow all investors to be able to participate in this private market space. At first we saw it moving down from the institutions and family offices down to high net worth related products. Now you can see the move is on to make it also available to retail investors as well. And then in Australia, fundamentally, there's a structural banking gap, that's really been filled by the private credit space. There was private credit's now $224 billion in Australia. It is expected to grow to $400 billion. And there's reasons for that, but the mid-market and the SME space is really being the opportunity that's being created for sort of private credit product providers, whether it be commercial private credit or sort of property-related private credit. That's been a significant opportunity, and I see that continuing in 2026. Now, on the innovation trends perspective, this is also quite an exciting time. If you look at the AI-driven growth, to give you a bit of an idea, it just didn't shift the market. It absolutely consumed it, right? So 55% of all global capital went into, global venture capital. It took that money. And then 70% of all seed and Series A funding went to AI-related opportunities. This is also the time, and I've talked about this sort of in previous events, where it's the exponential growth and the convergence of platform technology. And this is one of my favorite sayings that was sort of talked about in the ARC Investor Report, which I'll sort of refer to more in this, where they talked about it's the convergence, it's the S-curve adoption that is converging across all the various different platform technologies. So whether it be AI, robotics, energy storage, multi-omics, or blockchain, there's effectively S-curve on top of S-curve, all converging with each other. And that creates an exciting opportunity from a growth perspective. And this is one of the first times this has been seen since the actual second industrial revolution. And there's some projections around what happened at that time before it, what happened during the second industrial revolution, where growth went to, and then what's expected to go to with the convergence of these 5 technologies. And this is the exact reason why we've themed emergence, convergence, and abundance. So now talking about the AI GDP multiplier, what's really interesting, as mentioned, there's a convergence of all these various technologies, and it's expected that by the end of this decade, the GDP growth will move towards 7% global GDP growth, which is absolutely incredible. And so with that, you think about how much value is going to be created among some of the biggest companies, and also just in technology and startups and right across the entire market. Also, we've been moving from scarcity to abundance. And the simple reason is because the value of human labor, whether it be on the digital front or on the physical front, is going to exponentially decrease as both the combination of AI tools get a lot better and also robots start to roll out, both for personal use and obviously, for commercial use as well, and all the various ranges. And AI agents and digital infrastructure. This is where a lot of people are expecting the new layer of abundance to be created. And it's the facilitation of seamless transactions and coordination from agent to agent. Now, this is a great question that I've been asking during the meetup, and I think this is probably I saw this on X, and I always highlight to people there's an information arbitrage between what you get on X and what you get on something like LinkedIn. But it's a great question to ask: is what will the value of the biggest company be in 10 years' time? If you think back to the December 2005, Apple was the most valuable company. It was around about 590 billion or something like that, 596 billion. And then if you look at today, the largest company, which was NVIDIA, ended the year at nearly that 5 trillion mark. And it did obviously cross over at some point. So the question then becomes what will the value of the largest company be in 10 years' time? Is it 20 million? Is it 30 million? Is it 40 million, etc.? And I said, if what some of the projections are sort of outlined in some of the ARK Invest reports said, you really get to understand that thesis behind convergence and abundance. Now, for me, I said people always like to know what I'm sort of looking at from an AI perspective, because I obviously have gone right down the wormhole of AI. So if you look at all these, it's agents, 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 and more agents, right? This is 2020. It started in 2025. 2026 is absolutely becoming the year of AI agents already. And there's some incredible demonstrations of what people are building that you can see, and it just absolutely blows your mind. The 2 areas I want to really draw attention to is this bottom one, the bottom left, the human emulators and Claude Code, and even Claude Code. I'm a non-technical, so I don't really refer to Claude Code too much, but when I see what some of the people are doing with Claude Code, I wish I was technical. But the human emulators concept initially come out of a podcast. It was actually an employee at XAI. Let's just say he probably talked a little bit too much than what he should have. He actually ended up being let go within a week of this podcast being aired. But what he outlined in this was fascinating. He actually said in XAI, which is Elon's AI company, they're actually trialing human emulators. So they're trialing AI that basically emulates the way humans engage with a computer, whether it be the typing, the mouse clicks, etc., and the way they sort of work across different browsers. And effectively, those human emulators were actually put on the org chart, which is astonishing. So, and I've mentioned this beforehand, what it's going to look like about having AI on your org chart. You can see that they're already working on building that for the future. So that one's to pay attention to. And then the next one is effectively the agent-to-agent operability, one more. So the agent-to-agent payment rails is also something to pay attention to. So Google released their protocol, their AP2 protocol, so just agent to payment platform. And effectively, what it allows secure crypto payments. And their first partnerships were done with the Ethereum network, the Ethereum Foundation, and Coinbase. And so what gets people excited is that, you know, how you create the permission structures around those wallets, and then how agents can deal with each other. From a business perspective, you start thinking about then what does the future of business look like if it's agent to agents, you know, dealing with each other and operating with each other. So for me, why I'm so bullish on life sciences, and, you know, as I said, I would like to say a big thank you to the MTP Connect team. They've been incredible in introducing us to so many, you know, amazing life science companies. And to be honest, I feel like it's a space that's never really got the spotlight that it deserves. You know, Australia absolutely, you know, punches above its weight class when it comes to the world-class innovation that we produce and the research that we do. And there's always been that sort of criticism, or does it actually convert to sort of commercial? And we've really seen that over the last 12, 24 months. But the reason why my thesis went so bullish on AI is because of a number of different things. When I started to understand how AI could play a role in the drug discovery, the validation, the drug design, the trial design process, and even the preclinical trial, and also all the data related aspects, that become exciting. And then ARC released this report where they mentioned that AI drug discovery reduces development costs fourfold, from 2.4 billion to 0.7 billion, and cuts time to market by 40%, right? Which is massive when it comes to the life sciences area. The next part, on the medical device part, you know, it facilitates companies doing rapid prototyping, with either AI, simulation tools, and also 3D printing. They've all dramatically reduced the development costs. So the expectation from my side, we will see an explosion of companies sort of in these areas. And then also, what was a surprise for everyone is that, you know, especially given the interruptions at the FDA, you know, at the start of this year, effectively they've now got new national priority vouchers, AI sister reviews, all designed to actually reduce the review times from years to months. And there's it was from the World Economic Forum. It was one of the key people inside the health department. I think it's Oz Helmet, who's formerly known as sort of Dr. Oz. It was a great interview from the World Economic Forum with him on the All In sort of podcast channel. I recommend it to anyone interested in health and life sciences. You hear about what they were doing beforehand and how they just layered on the layers of bureaucracy for companies going through this process, and how they're trying to streamline it, simplify it, and just bring more pragmatic steps to basically accelerate some of this process and regulatory approval process for drugs, whilst maintaining the safety aspect to them. So very important for anyone interested in life science healthcare to watch that. And then lastly, there's just been massive success in the Australian ecosystem over the last 24 months. You know, companies like Neuron, companies like Telix, who we worked with when they were $1.50 and now at like $12. 4D Medical, you know, we worked with them when they were doing their seed round coming out of Monash University. Now to see them as a, you know, $2+ billion company is very exciting to see. And then EBR Systems Inc., as another example, you know, gone through their FDA regulatory approvals and actually started to sell to customers. You know, we've seen them go from like 140, 150 market cap to over, you know, to 450 and in the range of 450 to 600, and plenty of upside. So, you know, you're now seeing, you know, all this sort of, you know, the decade of work taken place over the last year in this space really coming to fruition. With what I highlighted there above, I expect that to accelerate over the next sort of 5 years. So the next one to talk about is the physical AI component, and that is the mobility revolution. And I always ask the question about when we're at events, you know, and I'm always looking outside and go, who actually likes driving, you know, in traffic? Absolutely no one. And the funniest part, some of us may like long drives, music on, you know, chilling and so forth, or, you know, but, you know, very few people like the act of driving. And the interesting thing about physical AI is if you think about all the great parts of your life that you just don't enjoy doing, that's its problem to solve going forward. But what was interesting is what's come out now is some of this research from ARC is that they expect that the cost of transport to absolutely collapse with things like robotaxi, and they're starting to see it where they can actually, the point-to-point transport can be 25 cents compared to $2.80 in a human ride-hailing service, and compared to 80 cents for personal car ownership, right? That is absolutely transformational when it comes to what people should expect, on the transport side. And then Waymo, as a sort of lead indicator for what's happening, they've now moved beyond San Francisco and Phoenix and in those areas, they've actually started to outperform Lyft, as far as how many rides they're getting. You can literally see the market share being taken away from Uber and taken away from Lyft and moving over to Waymo. Now, if you look at the competition between Tesla and Waymo, the difference is that Tesla can manufacture a car between that sort of $25,000 to $35,000 mark. Waymo's cars cost $120,000. Obviously, Tesla has mass scaling or mass scale production set up, whereas Waymo rely on sort of third-party providers for that. So a bit of a different strategy, but from a maturity perspective, it really gives insights for where the future is going. And there's obviously a convergent infrastructure related to energy with, that brings together AI, energy storage, robotics, and compute in Tesla's case. So in that XIR podcast I was talking about, they were literally talking about a business model where when people have got their cars at home at night, sort of just charging or just sitting idle, effectively they would pay customers to actually utilize their compute. That becomes interesting because then that means you've got effectively a DePIN, a decentralized physical infrastructure network that can be tapped into from a compute perspective. And they were literally talking about that business model going forward. And that leads to this next one, as always, typically being a leader, there will be others that follow. There'll be others that create solutions around that, because obviously the biggest trap right now for a lot of AI, or the biggest bottleneck, is getting access to compute. So a distributed infrastructure for that would definitely assist, but also likewise for all the charging stations, energy storage, all that sort of infrastructure will massively help accelerate the rollout of, the sort of the mobility revolution. And then the Wuhan model. So in China, you got Baidu's Apollo Go, which is now operating across 10 different cities, have now proved that they can make it unit economic level profitable for transportation as a service. And that you'll see that, over the next 10 years, that will become the business model of the decade. So something that I'm super excited about and keeping a close eye on. Now, the impact of AI in 2026, key things is AI agents are going to dominate everything. It will be absolutely the focus of execution for businesses. There was a bank on the World Economic Forum podcast where they actually did talk about how they're utilizing AI agents. I think, so I get, they basically have somewhere around 60 to 80,000 staff. They also have 20,000 AI agents operating across their business. And I know from our perspective, we've also been implementing AI agents across our business as well. Entry-level roles, you're seeing this, I talked about this last year, this is going to be ongoing. This is the greatest concern in the market. Over the last 3 years, it's talking about the wiping out of middle management, and that has been continuing and ongoing. But now there's just a significant amount of job reduction and jobs available for that entry-level roles, because obviously AI is playing such a significant role. But this is the most important one for most people to note, is the historical decoupling of growth and employment. So there's a great chart that come out which showed effectively the growth of the S&P 500 companies, and also their rate, their absolute reduction of headcount and job openings available, in that same period. And do you know when that all started? December 2022. So literally the month after ChatGPT was released, this transformation started happening instantly. And that's the power of AI. And going back to what I said before about the 5 technology platforms, it really does look as though AI has been the linchpin in accelerating the adoption across all those various technologies. Okay, so now when you hear about the growth of AI, again, people always ask, is it overhyped? And the funniest part is that AI is actually the the acceleration of AI has absolutely been bottlenecked. And I didn't realize this until I listened to a podcast from Gavin Baker, where he highlighted all the different challenges that AI has had in its rollout. So when you actually understand that it's been bottlenecked, you realize that effectively it's not anywhere near its boom yet. Obviously, people could have different opinions around valuations of companies, but as far as the potential for it, it's not even close. So the TSMC packaging, advanced packaging, the CoWoS bottleneck, that was a significant choke point for 2023 to 2025, as TSMC were very concerned, obviously being pragmatic in how they approach that. They didn't want to overbuild their infrastructure for a demand that may go away. So now, and especially the infrastructure requires years to build. They had concerns around that. The delay in the release of the Blackwell from NVIDIA. What was really interesting is with that delay of the release, basically what happened was a lot of the companies, whilst everyone was focused on pre-training at that time, for their models, what happened is because of that delay, they then started adding software layers over that to then advance the capabilities of their models that they were doing. And that's the reason why we've all felt the acceleration over the last few years, is because they've added things like reasoning to them. They've added things like deep research. They've started adding functionality around sort of agentic use as well. That's been at the software layer that's been done. And they've had to navigate things like smaller context windows and so forth. And that partially leads to the next one, is the high bandwidth memory shortages. Said they just could not get the production lines up fast enough to match the GPU speeds. And then, of course, the one that everyone knows, and I left that last because you would have been expecting me to say that first, is the Powerwall. Effectively, there is a lot of chips that are just sitting idle in warehouses because they just cannot get the power online. And obviously, the US is figuring out ways to navigate that. For example, they're providing permissions to some of the big tech companies to be able to have power stations on the same sites in which their data centers are, and to create solutions so that they stop the backlash of what's been taking place where energy prices have been rising in those areas. They're figuring out solutions for that. So the Powerwall part is something that's significant, and it's likely that they're going to look to solve it, obviously, as I said, with either power station initiatives or solar-related initiatives. And then obviously now it's being talked about what it could look like actually hosting data centers in space. And that's being talked about by all the big tech companies about how they would actually do that. So as mentioned, they sort of started developing all their sort of software related aspects on top of their models whilst that has been delayed. So what's really interesting is that effectively this next stage, this next stage really, I think, will be AI acceleration around life sciences, healthcare, and medical device breakthroughs. Now, what's my signal for that? Well, you've seen it across all the big models in the last 3 months have announced products or focus specifically related to healthcare. I did make a joke on, well, it's not much a joke, but I made a commentary on LinkedIn where, I was asking the question, is it more likely that the cure for cancer or the cure for cancer comes from a big tech model more so than from a drug pharma company? Now, of course, they ultimately will have to collaborate with each other. But when you look at, a lot of these times there's been there can be resistance for change inside of the typical sort of pharma processes. But when you're dealing with multi-trillion-dollar companies like the big tech companies, they are all seeing this as their problem to solve via their models. So science, maths, and materials breakthrough, this will also be super interesting. As I said, and effectively will also solve some other innovation challenges as well. So the discovery of novel materials and the building of autonomous labs, all these things will help accelerate physics and chemistry simulations, and ultimately, improve the rate in which technology advances. Infrastructure and energy, as mentioned, now you can see the attention is on, how can we actually get data centers in the sky, and then the process of actually converting that down into energy on Earth. And then obviously you got the next gen energy storage solutions, and we've actually got a company that's featuring at Emergence where they're basically one of the first that are focused around Perscovite solar, which I'm going to explain this terribly, but it's basically considered the next stage for solar panels and their ability to convert the sun's sort of energy into, obviously into energy that we utilize. And then the NVIDIA Vera Rubin platform. So again, because of, if you think about the sort of delays I mentioned before, effectively the Vera delivers 5 times the inference at 10 times lower token cost versus the Blackwell. And so it will power agentic reasoning and long context models. So my point in highlighting, the bottlenecks and also what I see as the next stage of AI acceleration is to highlight this last point, which is effectively I see this 2026 as its true acceleration year, because the hardware bottlenecks, become are lifted off. That gets so then a whole bunch of new potential gets unlocked via all the big LLM providers. Agents explode, progress surges, and there's, most importantly, there's massive amounts of competition both in the US and also in China, and then you've got the geopolitical competition as well. All of that will basically be foundations for the acceleration for AI in the year ahead. So this is one of my favorite slides to cover, AI tools that I use every day. So at the moment, Claude 4.5 is just in a league of its own. It is like the employee that you hired that ends up being the ultimate star performer you didn't know existed. It is just incredible what Claude 4.5 does. I use it pretty much for 80% of what I'm doing at the moment. Claude Cowork also, it is, if you want to understand what potential agentic solutions could look like, just try Claude Cowork. There's some plenty examples online of different things you can trial with it. Unbelievable. Google AI Studio, another favorite of mine that I like to use, great for working across the sort of Google ecosystem types of docs, and also just great outputs. My favorite one is Fixer. This has been an absolute game changer for me. It promises to save you an hour a day. For me, I feel like it does a lot more. Okay, we had a minor technical delay with the audio, but we are back. So I was just mentioning about Fixer is my favorite. It's basically positioned itself as an AI executive assistant, and it promises on the website to save you at least an hour a day. For me personally, I've found it being so much more than that. The amount of cognitive capacity that this has given me back, because effectively it goes through your entire inbox, it classifies your emails. For me, I get probably 300 plus a day. And you effectively realize that 90 to 95% of the emails you get are not actionable emails. So it's very, very, I found that as a super powerful tool. So that's Fixer. And you'll find when it gets that, it starts to draft reply emails after it classifies them. It starts to pick up on your tone of voice. It takes about 3 to 4 days to get it right. You'll be astonished with some of the replies that it has to emails. For me, I've seen it answer 9 questions and nail every single one of them, off one email. So really, really impressive. Lindy.ai, again, this tool blew me away because it meant that I could build my own AI agents. And you can do it by prompting. So when I saw some of the other tools like N8N and so forth, I'm a non-technical person, and I do my best to be on the boundaries of what's possible as a non-technical person. And effectively, the Lindy AI has really helped me do that. And by the way, all these have free accounts, so you can go and test them out for 14 days or whatever the testing period is. But go and do it, because you'll be surprised. And again, I'm all about testing out what the potential of human capacity is, and you will find that you can do so much more. So, great one to do. Gemini Notebook LM. Notebook LM has been the real surprise one, and it doesn't really get talked about that much, but it's absolutely powerful tool. Like, for example, I got a 100-page report the other day about how a company's utilizing AI agents across their business. And what's so beautiful about it, I can just plug that in and then start asking questions away on it. And also I can have it actually go and do its own little podcast overview. I can have it create a slide deck from it. I can have it do a mind map of exactly the processes, etc. Incredibly powerful. Gemini, again, one of my favorite tools, as mentioned before, with sort of Google AI Studio. They're powerful models. I find with ChatGPT, I'm using it less and less. I'm pretty much using it just for creating prompts at the moment. So next one, beautiful.ai and Gamma. So this presentation is done in beautiful.ai. I'm terrible at PowerPoint presentations, so it just makes it really easy for me to create those. Tried PowerPoint, tried Google Slides. They're all useless compared to something as simple as this. And then the other one that I found that's really helpful is Gamma. Gamma can take any bit of text or PDF or Word doc or whatever and just turn into a beautiful presentation. All you need to do is you just need to upload your brand colors and your fonts, and you'll be able to start, producing incredibly beautiful documents. So they've been two of my favorites for that. Whisperflow and Grammarly, this is my two. Like when I discovered these, I felt like I was just hacking business life. Basically I'm a slow typer. I type between 30 to 40 words per minute. And by using Whisperflow and Grammarly, I'm now up to 134 words per minute. The reason why the two are actually quite good to use, because they go across all your different browsers and all your different tools. And effectively, as soon as you finish talking, it basically, now when you see voice texting, oh, that's been around for a while, not like this. I don't know how it does it. It's got perfect punctuation, structures the sentences exactly how you want it. If you say 1, 2, 3 in a conversation, it then outlines them on the different lines. It's just they've done an incredible job. Like I strongly recommend everyone to download Whisperflow and Grammarly. If you type over 100 words per minute, you may not get as much benefit as someone like me, is typing at 30 to 40 words per minute. But absolute life changer, that tool. And then some of my other favorites, and you know that this war is going to be fought within the browser, in 2026. And obviously, OpenAI released Atlas for ChatGPT. It's only available on Mac. The one I use mostly is Anthropic's with their Perplexity browser. And then also I've got a Chrome plugin for Claude that I use as well. So I've got just the top one, the $100 a month one. And it is how much easier it makes going through things rather than copying and pasting all the time and so forth. It is incredible what it can actually do. And also I find Claude Cowork combined with those is also incredible as well. So, these are the tools that I use every single day. I recommend go and use the free trial for yourself on all of these and start utilizing them. So venture capital trends in 2026, we're now seeing obviously the AI takeover I've sort of talked about quite a bit, but the deep tech focus is really interesting. In our survey, tech in general was number one, and then deep tech was number two. And this is, you're starting to see, and I think the core driver behind this has been a top venture capital trend for 2026, is that investors are effectively looking for companies which have some form of moat, whether that be IP related, whether it be technical related, regulatory, data, whatever it may be, or distribution, etc. They're looking for some form of moat. So this means, and this is exciting because obviously for the last, 14, 15 years, there's been a strong focus on investing into software. And now you see that bifurcation where people are either looking for, effectively the high growth sort of AI, or they're looking to go into deep tech as an area. Climate tech and clean energy and sustainability is obviously going to be a focus in 2026. These two soaked up the majority of capital in 2025, and it's likely to continue in 2026 because energy is just such a big requirement. And obviously with all the sort of mandates globally around sort of renewables and sustainability and so forth, that will continue to drive that momentum. Health tech and biotech, this is the one that really excites me. For me, I feel like AI is a big trigger for the life sciences and healthcare space. And I gave my thesis at the start of this, but you're likely to see this as you will see this as a strong trend in 2026. Cybersecurity, we've seen this over the weekend with Maltbot and Claudebot, or whatever it's called now. It's effectively, as these new agentic tools get released, there's going to be issues related to cybersecurity. So effectively, there's going to be a significant rise in investment in cybersecurity going forward as it learns to deal with AI agents. And then the return of fintech in 2025. It's been interesting. It felt like for a few years, fintech was on the down low and sort of out of favor for investors, but it's come back with absolute vengeance with some big funding rounds, big investments going in. And people are now really seeing that there actually could be a new future of finance that relies less and less on the traditional banks. And then B2B software, if you look at the success of 2025, it's really been the B2B software verticals that have played out incredibly well. And we expect that to play out in 2026 as well. By the way, I said all this has been done from all sorts of research reports around the world, and also obviously locally in Australia. And also from what we've seen from the funding, all the different funding reports that are coming out. So this is the expectation for 2026. For global venture capital trends, from chatbot to atoms, as I sort of highlight that shift to physical AI, that is absolutely on. It's Elon stated that he expects the sort of human robot to be, or his version of Optimus to be, the biggest selling product in history. And, you can see why it's relevant. People have so many different gray areas of their life of things that they just do not want to do, whether it could be cooking, cleaning, driving to different places. If you think about all the time you spend doing all the things that you don't want to do, there is now companies working on building robotic or physical AI solutions to solve those for you. So it's interesting to see that coming down. The sovereign safe harbor. There's obviously now, with all the geopolitical issues, more and more governments are looking to build their own, define the national resilience. So whether that be energy, whether that be pharmaceutical, basically governments are going to be more proactive in investing in their own sort of homegrown sort of resilient solutions. Genuine IP modes, as I mentioned before, and then obviously the expectation that the bifurcation of venture capital will continue with the combination of AI and America. Obviously, there's been some incredible success stories out of Europe in the AI space, but expect that the dominant amount of capital will be in the US, and especially as you've got some of these big IPOs coming out as well. So on the digital asset side, as you all know, this is one of my favorite areas. So the digital asset trends beyond the banana zone. So obviously what we expected to happen with a sort of, normally it goes ballistic sort of in that period. It didn't take place for a bunch of different reasons, but however, the momentum is still there. There's an absolute, with the Clarity Act currently going through its sort of approval processes, there's an absolute wall of capital ready to come in for the investment in digital assets through the various institutions. So the big trend, we've been talking about this for 2 years, is RWA, the real world assets, the tokenization of assets. And this will be a big focus. And I remember saying this at a conference about 8 years ago. Markets move towards efficiency and to solutions which basically save time and save money, right? And obviously the tokenization of real world assets is a big one for that. But the reality is, the fact that BlackRock come out in their chairman's letter with Larry Fink come out and highlighting that effectively this is going to be a predominant focus for them, that's a pretty big signal for the rest of the markets that this is what's to focus on. And, typically they do dictate, sort of the priority of the focus. The AI economic layer, agents and DPIN, this is something that's super interesting. It said you literally saw some of that over the weekend. But effectively, the value creation layer of agent-to-agent protocols and payments and purchasing of services and products, etc., will become the battleground over the next few years. And also, it's something that's very exciting as far as how much more, I suppose, wealth and sort of productivity that can be created through that. And then on the Bitcoin side, you see that nation states are actually starting to accumulate sort of strategic reserves, and that will absolutely continue. Obviously, the US sort of started with some of their mandates, but effectively, you are going to see more and more sovereign funds start to allocate digital assets in their balance sheets, and that will also drive it. Likewise, you're still seeing listed companies doing it, accumulating more and more, but now you'll also see it on the government side. And this one's the interesting one. Stablecoin is the new SWIFT. If you think about it, we've all known the banking system to be our sort of solution for making payments. Well, the movement from 3 days to 3 seconds is something that's very appealing. Once again, markets move towards solutions which save time and save money. And so, effectively, the way you're seeing this is in the creation of value with companies like Tether, where they're doing ridiculous. So Tether right now is in the top 5 of the most profitable. As they would be considered, if they were considered a bank, they would be in the top 5. There's some crazy stats coming out that with 300 employees, they're spitting out something, I think it's like $15 billion of profit, or something like that. But their value itself, the value of Tether, has been positioned at anywhere up to 500 billion. And when they've only got sort of 300 employees, that gives you a bit of an idea as to the value of each employee in that company. And if you compare that to someone like JP Morgan, where they've got 300,000 employees, and you look at their market cap, I think their value per employee is like 1.3 million or something. We are literally sort of seeing, experiencing, and witnessing the changing of the banking infrastructure and those financial rails going forward. And to note that stablecoins already do more volume than MasterCard and Visa card. So, keep an eye on stablecoins for this year. Private equity trends, the ASX valuation arbitrage is expected to continue. Obviously, sort of 2024 and 2025 really sort of set the tone for that. But effectively, there is just so much more opportunity. The amount of private markets capital coming in, and the PE firms that are looking to do deals with great companies that are listed on exchanges that are just undervalued is something that will continue. There'll be a surge in M&A and deal activity, right? And obviously, as dry powder gets deployed, new PE firms are raising funds. There's new private equity fund models, like stuff that we're doing with Volloop. Is an example of a new product where effectively it's helping SME owners go through a successful employee transition and effectively allowing the owners to move to retirement. You've got demographics in play, you've got capital on the sidelines, and then also you've got the integration of AI and technology. So those 3 factors, really sort of align, with why there's going to be such a drive in private equity investment. And also just noting, like, it's second top for us. So as private equity was second as far as investor interest. So, keep an eye on private equity for 2026. But I know from the investor side, it's an area of strong interest. And then obviously the focus on infrastructure and real assets. So yield, basically high net worth and family offices are effectively seeking double-digit returns on the yield side. There's obviously a supply problem on the sort of residential property side, and effectively that's creating the funding opportunity for providers, and that's giving them opportunities to get access to double-digit yields. And there's just an obviously built-in structural demand. Going back to my first slide, where we're talking about sort of just the sheer demand for housing to be created. On the commercial real estate side, going through all the different reports, basically highlight there is once again another example of bifurcation in that industrial property has really been the hot sort of topic on the high net worth and family office side. And then likewise on the commercial property side, certain assets have really captured sort of investors' attention with, what was expected to be challenges. They've been able to sort of withstand that and also still be producing significant yields and also significant upsides for investors. But there is sort of caution on some of that on some of the commercial property assets. And then the biggest growth over the last couple of years has been the amount of money going into SME growth assets through private credit. So effectively, investors seeking that double-digit yield, but getting access to companies, getting access to SMEs that are looking to expand. So the SME, to me, I expect, from everything we sort of looked at, I expect that to grow over 2026. So investor appetite, fundamentally on the private credit side, desire for hybrids. So investors want yield and growth, and they're and I'll give you an idea what they're targeting. Just pure yield and capital preservation is sitting at 33%. So it's definitely investors are open to risk. The sweet spot IRR that investors are looking for is between the 12 to 18%, with 42% of investors highlighting that that's what they're looking for on a return perspective. And then for pure yield deals, investors are looking for between 8 to 12% for yield. So just to give you an idea, and this is all from our latest survey. Macroeconomic factors, always the fun one to get to in these types of sessions. So effectively, you got interest rates. They obviously just announced the new Fed Reserve Chair. Effectively, there's a strong expectation that interest rates will come down over the next year. It's always, you sort of can't bet the house on it, but effectively, obviously the government is strongly pushing for interest rates to come down. The US does have their inflation under control, unlike Australia. But effectively, if interest rates come down, that is, and we all know there's sort of potential for dry powder coming off the sidelines if that happens. Also, the other big thing, and this will be interesting with the new Fed chair, that there's a delicate balance in that effectively there's $9 trillion worth of debt from the sovereign, from governments around the world that needs to be refinanced, over the next 12 months. So effectively, there's expected to be some money printing going on as part of that refinancing strategy. So the sort of quantitative tightening, is likely to move to quantitative easing because they do need to refinance those debts. And by the way, you can see the big motivation for the US to try and get interest rates down for when they actually go to do that refinancing. And then likewise, as I say all this, with the expectation, with the optimism that we don't enter World War III, right? So I'll just flag that it's a massive potential economic factor. But war does play a role at the moment because there's just so many geopolitical issues going on. But effectively, that trigger effect, and we've seen some benefits of this over the last sort of 12 months, and the last 24 months really. But all the different factors outlined before, and as far as the technological evolution, the technology innovation itself is deflationary. The convergence of all the different technology platforms going through their S-curve adoption phases, combined with these different factors, there is a reason why the head of Howard Lutnick, the Commerce Secretary, highlight that he expects inflation. He expects GDP growth for the US to be in that 5 to 6% range, and then like what I highlighted with the US before. So very, bullish on that factor, saving World War III. So the US, I'll highlight some key parts. Now, one of the biggest things I just strongly recommend to all our audience is there is so much noise that comes out in the media about the US. If I was just ignore that noise that comes out, ignore the media headlines, because it feels like effectively Trump and the US get somewhere between 4 to 6 negative headlines a day. And it's being calculated that it's 98% negative media coverage around Trump. So if you actually want to make your investment plays, that sort of noise makes it very difficult. I strongly recommend you to listen to the interviews with the likes of Scott Bessent, for example, the Treasury Secretary, the Commerce Secretary, Howard Lutnick. On the health side, I recommend, I think it's Oz Mahmoud. I always get his name wrong. But before you know, as Dr. Oz, listen to RFK, listen to what they actually say in their interviews and what they're prioritizing, what they're focusing on, because that will be more of your signal and will be, less of the noise. Of course, you can go and listen to the commentary about it, but I tell you, but the key thing I'll highlight with this is the US has reported, basically White House reports 9.6 trillion in total announced US and foreign investment pledges. That was part of trade deals they did related to the tariffs. So when they decided to, annoy us all with the tariff announcements in April and, create a whole bunch of instability, it did bring everyone to the table. And there's a whole bunch of deals around, reduction of tariffs, and then obviously inbound investments from some of their big corporates or from the actual governments themselves. Analysts predict that's close to 7 trillion, but in reality, compared to the previous Biden government, I think they brought in something like $450 billion of inbound investment. 7 trillion is astonishing. Of course, that gets deployed out over years, but it's a bit of a signal for what's to come, because that's a pretty good effort in 1 year. Also, a small note that came out earlier this month, or earlier in January, I should say. I'm recording this just in February. But the Atlanta Fed highlighted that their update that the growth, the GDP growth is tracking around 5.4% annualized growth. And I said the US Commerce Secretary is highlighting 5% plus. So that's a massive signal, because if that is on track, then effectively an economy the size of the US printing out that much or spitting out that much growth is a massive signal for the markets. And the only time that that's been previously done is when you've got high growth economies like India, etc., or very structured economies like China, as an example, where everything's sort of laid out. The dawn of the $1 trillion IPO, there's lots of buzz around potential $1 trillion IPOs, whether it be the likes of SpaceX or OpenAI as an example. And then you've got the likes of Anthropic, which owns Claude, and then also Databricks, as a potential. There's a whole bunch of other ones as well. The reality is there's a potential for $2.5 trillion worth of IPOs in 2026. If that takes place, the amount of value and, I suppose, wealth that gets unlocked as part of that IPO process is very significant. Like, it's a big signal for a lot more money, because often that gets reinvested back into the actual ecosystem itself. So, and then the last one is the S&P 500 and the NASDAQ. Obviously, they're two of the dominant markets, producing incredibly well. They're up 17.9%, and the NASDAQ up 21%. So global capital is focused on US equities at the moment. So it'll be interesting to see how that plays out through the year. By the way, it has been noted by by Scott Bessent that one of their challenges in the US, whilst all this has been taking place, Main Street hasn't really received the benefit of it yet. And their expectation is that they'll start to see the benefits of that through programs like tax cuts, like increasing in GDP, and also sort of moving more to the reduction of inflation as well. So it'll be interesting, because they'll become important when it comes to their their primary elections towards the end of this year. So deregulation. Basically, there was a stall in M&A for about 2 years. Now it is just completely, it is a focus area right now. And if you look at the likes of Nvidia acquiring Grok, it was done on an interesting deal. It was like an acqui-hire and / licensing deal. Likewise, Google did this with Windsurf. But there is a massive amount of cash sitting on corporate balance sheets prepared for M&A opportunities. And it sort of starts with tech and then obviously filters down to other markets as well. So basically, that's the pro-business side, right? So I won't talk about the social aspect, because that's a whole other sort of wormhole to go down to. But from the pure business side, that's what's been happening in the US. And I put this slide up last year about what to expect from the government. And it's basically, I said, it's one of the rare times where you can have a look at past performance is a good predictor of future performance. This was exactly what the focus of the actual government did in the first time, but with the highlighting that the focus on technology dominance and the focus on energy dominance, or making that as a focus on building energy capacity, that was a new layer. But the others was pretty much what he did first time around. So it's the first time I've had to look. Okay, this is what they did last time. This is likely to indicate what they'll do again. And effectively, it's on track. The Genius Act was significant from the stablecoin side. Now everyone's waiting for the Clarity Act. And that said, the Clarity Act going through its processes, as I said, it's been highlighted in several different places now that there's an absolute wall of money from the big banks, looking to get access to digital assets once that is actually done. So results from our Wholesale Investor survey. Fascinating to see that tech in general, I should have had tech in general was actually at 41%. So that was sort of the top one. But then deep tech was 37%, private equity was 34%, health tech and life sciences were 31% each. So it just validates, exactly everything that outlined in those sort of predictions for 2026. When I surveyed you guys, this is what you told us about what you're focused on. So it really does align with that quite well. Investors are focused on the jockey at the moment. 77% highlight the number one decision factor for investors for them is who's actually the management team. And if interesting enough, ESG credentials went down to 11%. So there's been a significant turnaround in that as a focus over the last 2 to 3 years. The sweet spot, seed investors looking was at 38%, which was really interesting to see. Series A and B, obviously the preferred point at 45%, but still seed at 38% for investors was very, very high. And then pre-IPO at 39%. And once again, that lines up with sort of the IPO market being technically open. More investors are open to potential pre-IPO opportunities. Number one frustration for everyone is lack of liquidity and exit options as the biggest pain point. I said, hopefully with a good IPO market this year, that can be solved. And then private credit, yield and growth is the sweet spot for everyone, which was number one at 43% of investors looking for yield and growth. So that concludes the survey part. So in summary, 2026, a rare window of opportunity for founders, investors, and advisors. This is the greatest time to build and invest in 30 years. It's an incredible market. As I said, there's a whole bunch of different factors all coming together at one time. As I said, barring World War III, said the expectation is 2026 is going to be a very, very significant year across a range of, as I said, it is the best time to access growth, and high yield all at the same time. All right, so thank you very much, everyone. I hope you enjoyed that session. So here's my details if you'd like to add me on LinkedIn or if you'd like to email me. I hope you enjoyed our Emergence preview and sort of what I've been covering as part of my investor meetups. I'll just say this, at this point, for everyone coming to Emergence, you are going to absolutely love it. I've never had anyone come along to our Emergence conference and go, geez, that was a waste of time. The access to information that you get across 3 days, the access to insights, whether it be from the speakers on stage or the people in the room, is something which makes it highly, highly valuable. As I say, people meet people that end up going and doing significant commercial deals, investment deals, etc. This is the best lineup of companies that we've ever brought to the event. And, whether it be, you've got companies that are backed by hospitals, backed by VCs. We've got a company that's doing over $20 million of revenue. You've got companies that are taking on different areas, like got a company that's in the seaweed space that's taking on biostimulants, which, massively improves the soil from agriculture. The med tech opportunities that are coming to this, that are solving real problems in the actual medical space. And then likewise on the life sciences space as well. So Australia's got some incredible life science companies, and you're now seeing that come to fruition in the ASX listed markets. But, we were working with these companies 5 to 10 years ago. Now these companies are unicorns. So I've never been so fired up for a conference. And I tell you, with the time I've spent speaking with the founders, it is just so heartening that aside from what's happening on the political side, the ambition and resilience and optimism that's sitting inside the founders in our ecosystem is what makes and drives me every single day. So ladies and gentlemen, I look forward to seeing you all at Emergence. Again, I hope you enjoyed the preview of the companies being featured at the event. And I hope you enjoyed my sort of, thoughts and insights on what I'm seeing and what my sort of own thesis is. I look forward to seeing you at Emergence 2026.